Jamie McIntyre here, CFO 21st Century Education. I'm joined by Harry Dent, one of the US leading economic forecasters, also the author of The Great Boom Ahead and his latest book, The Great Crash Ahead. Harry, great to have you in Australia. Excited to be here?
Oh, my favorite country in the world, literally. If it wasn't so far away, I'd live here. Yeah, especially in a slowdown. You guys are going to weather this better than any developed country on the earth.
Yeah, we were talking earlier about that. You know, as far as the global credit crisis too, do you believe that the world's going to go into a second global recession?
Yeah, I do, because Europe has not really changed its debt situation. It's just pushed it off. The U.S. hasn't written down debt against how property prices have fallen. They've just pushed it off. So we think they're all running out of bullets. Yeah. But the biggest reason, something we've warned for a long time, demographics. The baby boom generation pushed up the economy, spent money, pushed up real estate around the world, and once you get past your 40s, you stop borrowing, you stop buying real estate, you save for retirement, then you retire, and it slows the economies. So the economy,
which makes a lot of sense when people hear what you talk about that, because I read your book many years ago, and the baby boomer trend, and that was coming, and I guess
that's why we were so bullish.
I guess that's how
we were way more bullish than most people, because we saw how big the baby boom was around the world. It wasn't just the U.S. It was Europe, North America, Australia, New Zealand.
And I guess that enabled you, because you're one of the few economists that were able to predict well in advance of the credit crisis in 2007, 2008.
Well, when we predicted the great boom ahead, we also said by 2008, economies will start to slow. We'll go into this deflationary
And that's based on peak baby boom spending.
Baby boom spending and borrowing. Because, again, you see the U.S. trying to stimulate the economy. You wonder, well, why is it not working? Trillions of dollars. Because baby boomers don't want to buy houses now. They don't want to get more in debt. They're already too much in debt.
I guess you're saying that the kids also left home. They left, and they want
exactly
a smaller home, and they're also probably maybe a little bit afraid about retirement. So instead of spending and splurging, they go, "Oh my God, I need to save. I'm going to run out of money before their time runs out."
Yeah, you change. When your kids leave the nest, that's where you spent most of your money, and that's why you needed a bigger house. That's why you drove your car so many miles a year, carting them around. So the whole dynamic changes, and this is something you can see coming, and economists just don't look at this. The other thing we point out, Japan already went through this. They had their baby boom earlier than Europe, Australia, North America, and they had a bubble in stock, bubble in real estate, and then they said they couldn't slow down, and it slowed down, and the bubbles burst. So the thing is, just see this coming.
It took more than 10. It was still going.
Yeah, it's still going.
So are you suggesting that US could go into a Japanese-style recession for the next decade?
Yes, I think Europe keeps slowing down, and their debt problems get worse. Then the U.S. gets a second crisis. U.S. has the greatest private debt crisis in the world. Europe, outside of Japan, has the greatest government debt. So it's in different sectors. And then that hits China's exports. And then China slows down. That hurts commodity prices a bit, and then Australia starts to feel it. If Australia was on its own, and it wasn't for this crisis in the world, your demographics and migration are stronger than any other developed country. And that's what's kept your property prices up. If it weren't for this world debt crisis, Australia would probably just grow slower with the aging baby boom, but not see a crisis. So I think you're going to get it more imported from the outside.
So in saying that, with what country or countries would you say are the ones you'd certainly want to be in the next 10 years as the world slows down in this Japanese-style recession?
Yeah, well, definitely. Australia, New Zealand, Canada, maybe Singapore, and maybe Switzerland. I think Europe's going to see a lot of social unrest. The U.S. is going to see a lot. And we have the bigger debt crisis, so it's going to hit more. It's already hit Japan, and Japan's just going to keep slowing. But I've always said, if I could weather this in any one country, my #1 pick would be Australia.
Yeah, I guess that will make Australians happy. And I agree with that sentiment. I mean, I was talking earlier about Australia as the continental landmass of the United States of America. Has actually more natural resources, but has only 24 million people, 7% of the US population. So in that essence, Australia has been referred to as the lucky country.
Yeah, and what I say is, don't push your luck. You're lucky. Property prices have held up here. Well, don't keep investing in real estate if it's that high. The property prices here have now gotten as high as they did when they finally cracked in California. I think it'll take longer here. We had a banking crisis triggers art. I mean, where I am in Florida, in Miami, and Tampa, real estate prices literally went down 50% overnight. It happened in a year because a banking crisis triggered it. I don't think you're going to have that. But they have gotten so expensive that young families can't afford it. So they have to kind of drift back down to reality.
So, and obviously that's been controversial in Australia. Obviously, you mentioned about the idea. I mean, Australians love property. You mentioned, up
well,
to
so do Americans.
Yeah, it's like up to 40% crashes, and a lot of people had opposing views to that. But I guess in your defence, and I've come out to on my blogs and to 21st Century members and said in the last 12 months I'm no longer bullish on Australian house prices. Yeah. I'm not a believer that it's going to crash substantially, but there's certainly going to be a flatter period. The best years we've seen in the last.
That's right.
Few
it would be hard to appreciate from here.
Yeah.
That's something.
Yeah, I've certainly told people not to be bullish, but one thing in your defence, I would say I have a home on the Gold Coast. I've also had homes in Sunshine Coast in Noosa before, and those markets, a lot of people don't realise, the top end of the market actually did after 2008. They have crashed 35 to 40%. Exactly. So I guess in those Miami or Las Vegas style markets, are similar demographics in the States to those markets in Australia.
When you see a lot of vacation homes and tall condos and stuff, just like the Gold Coast, that's where they crash the most. Miami was one of the worst markets. I mean, California actually was more overvalued but held up better than Florida because there wasn't as much speculation. The prices were high in San Francisco and LA, but real people were living there. In Florida, people were buying stuff on spec, and these condos were empty. And then Dubai, I was there a couple of years, twice before the crash. Yeah. Nobody in any of these places.
Empty buildings. So would you say Australians, as property investors, should maybe look at diversifying to even possibly buying US property?
Yes. If you can buy, and I know some people, I met with groups that are bringing people from Australia over to places like Arizona, where you can literally buy, and I say, don't buy high-end homes, don't buy speculative, buy everyday homes on the low end that now in foreclosure can be 50, 60, 70, 80% off. You can rent out at positive cash flow, which you cannot do here. And then the US dollar has been going down for decades. It's going to go up over time, and your cash flow, you're diversifying not only your expensive real estate into affordable real estate, you're diversifying your strong Australian dollar into the weakest currency in the world, the US dollar. So to me, I think that's a real win-win if you can do it with a company that can manage it for you. You can't just run over there and buy a few houses from here and then run back. You have to manage it. You have to be able to rent it for you.
Yeah, no, definitely. I've been to cities like Phoenix, etc. I bought some houses there myself.
It's a nice city. I like
we've
Phoenix.
seen houses that were $250,000 at the peak in 2008 that we've been able to buy 70, 80,000 middle class suburbs.
And that's what you want. You want starter homes because the next generation, the Echo Boom, is going to want a starter home, not a McMansion, and the aging baby boomers are going to tend to want to trade down to smaller homes now their kids are left. So you want the modest size homes. You don't want the big house.
So I guess you're saying Australians are focused on cash flow returns in the US. I've been saying to people, capital growth in the US is a bonus. I think in some cities like Phoenix it's possible, but certainly if you get your property paid back in 6 or 7 years, who cares about the capital growth?
The truth is when you get a financial crisis like this, real estate is slower to come back. So yes, you do it for cash flow, and I think people would get the biggest reward from being in US dollars. I think our forecast is the US dollar is going to go up versus currencies like the euro or the Australian dollar 30 to 50% in the next several years. I mean, a big move.
That's interesting. So you're here obviously in Melbourne to speak at the 21st Century Financial Education Summit. What message can you have for investors or everyday Australians of how they can maybe profit from the volatile times that are coming in the world economy?
Well, first of all, the smart money. The 1% of people that make most money in investment, the 1% of entrepreneurs that control most of the wealth in countries like Australia and the United States, they like change and volatility. It creates opportunities for them. Volatility is good. Most people like a nice steady property market or stock market that just goes up and they can buy on dips. So we're saying that's going to change. So the message here is entrepreneurs. I mean, more millionaires are made per capita in the Great Depression than any time in history.
Yeah, it's true.
Entrepreneurs did well in the 1930s and 70s, and investors who are more flexible and find the type of trading systems to take it. You have to be able to go up and down now in investments. So that's how you make money, and you should make more money if you see this slowdown coming. It should be seen as an opportunity, not as a threat. I mean, I've been bullish for 20 years, so I'm not a doomsayer. But hey, 92 million baby boomers in the U.S. and similar in Europe and here. You can't fight them. They're going to slow down no matter what governments do.
Yeah, well, they do say the Chinese problem crisis is opportunity, and I think that would apply. And I guess it's also saying that the typical financial planning type stuff, buy and hold stocks over the long term.
Not working. It worked all through the boom. It's a good strategy most of the time. We've been warning financial advisors for a long time now. When this financial crisis, when this bubble unravels, everything tends to go down, so diversification doesn't work. You have to be in counter investments or systems that can play up and down, or in things like cash, safe investments, and then the U.S. dollar is the one thing that went up in the last GFC. The U.S. dollar went up 30%. People don't remember that.
Wow. So I guess you're saying, obviously the Financial Education Summit, the reason people here is to get a financial education. They didn't get at school, they didn't get at university, and they generally won't get it.
And you're not going to get, I'll tell you, you're not going to get it from economists. We teach people in simple human terms what drives the economy. People cause inflation. Young people are inflationary. Old people are deflationary. People spend money between age 20 to 22 and the end of the workforce, spend the most at 46 to 50. We explain everything in the economy down to things, predictable things people do, like the audience. So the audience says, well, now I feel like I can understand the economy. That's the whole point. It is education. I'm not so much about whether the economy goes up or down. It's just if you understand it, then you can see the economies always go up and go down. Inflation's always followed by disinflation and deflation in history. I study history, so all you need to know is what direction trends are going, and then it's an opportunity, not a threat. That's simple.
Sounds great. Well, it's great to have you here in Melbourne. We look forward to hearing from you at the Financial Education Summit.
It'll be fun, I guarantee you.
We'll see you soon.